It is never too late to start investing, but the earlier you start, the more money you will have over time. When you invest early, your money has more time to grow and compound. Investing in stocks and bonds is a good way to start building wealth for the future. However, it's important to diversify your portfolio so that if one investment does not work out well for some reason, there are other investments that can help make up for it. How to invest in stocks for beginners. Investing in stocks is a great way to make money. However, it is not easy to know which stocks to invest in and how much money should be invested. This video will provide some tips on how to invest in stocks for beginners. It is important that you do your own research before investing. You can start with watching this video and then move on to other sources of information that are relevant for you. Investing in stocks for beginners can be tricky. The first thing you need to do is to find the right stocks to buy. But how do you know which stocks are good investments? In this video, we will go over some of the best early investing tips for beginners so that you can take your first steps into the world of investing. 1. Set your objectives. Setting long-term objectives can be of great benefit when investing in stocks and shares. Whether you wish to save for your own retirement or for your child's education expenses or to buy a property or any other reason, setting long-term goals will help you better understand the importance of saving. Your investment portfolio will grow based on factors such as the amount of capital invested, the tenure of the investment, and the net annual earnings on the capital. It is advised that you begin investing as early as possible as it can help you save a significant amount of money. 2. Level of risk. The level of risk associated with the investment option you choose must be carefully analyzed before you put your money into something. The best way to identify the risks associated with various products and identifying the best option is to conduct a comprehensive comparison between the different schemes. Doing so will enable you to figure out what level of risk each product holds, and you can invest your money accordingly. Understanding the level of risk involved with investments will help you avoid those instruments that have the potential to see you incur losses. 3. Control over emotions. One of the primary requisites of investing in the stock market involves controlling your emotions. The market sentiment towards a company becomes evident through the price of its shares. For instance, if most investors are skeptical about the prospects of a particular company, the prices of stocks and shares will reduce. Similarly, when investors show confidence in a particular company, the prices of its stocks and shares will increase. As stock prices keep changing, investors start to feel insecurity and tension, creating questions like whether or not they should sell their stocks in order to avoid losses, or if they should retain the shares and hope for a rebound in prices. Since actions are primarily driven by emotions, it is essential to ensure that all factors are analyzed carefully before making a final decision. 4. Study the stock market. Prior to making an investment, a beginner in the stock market is advised to study the stock market for the basics, including the various securities that compose the market. The fields that must be focused on include order types, financial definitions and metrics, various kinds of investment accounts, timing of investment, methods of selecting stock, etc. Gaining a thorough understanding of the stock market will ensure that you're in a good position to assess risks and make the right selection. 5. Diversification of investments. Diversification of stocks is mainly done by expert investors after all the research has been performed to classify and calculate the risk associated with their investment. However, beginners will have to gain some experience in the stock market before undertaking the diversification of their investments. Diversifying exposure is among the most preferred methods to manage risks. If you purchase stocks from 5 different companies and expect the prices of each investment to grow continually, there may be situations wherein 2 of the companies may have performed exceptionally, acquiring a 25% increase in price. The shares of 2 other companies may have increased by 10% each, and the shares of the 5th company were liquidated to clear a huge lawsuit. Since liquidation of shares results in a loss for the investor, diversification can help you recover that loss through profits from the other companies, thus making it better for the investor than invest in only one company. Follow these things before going to invest. Do your research. Make sure to do your research before making any investments. Research the company and make sure that it is a trustworthy investment opportunity. Invest in what you know. One of the most popular investment strategies is investing in what you know, or what you are familiar with. For example, if you work at a company that specializes in shoes, then maybe invest in a shoe company. Start small. If this is your first time investing, don't invest too much money at once and start small. You don't want to risk too. Thank you for watching my video.